Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we have our favorite show, the Primary Vision Frac Spread Count. So we're going to go over what's happening with U.S. activity, what do we see happening over the next month into 2 months, and then we're going to go into some of the recent data sets, more importantly, what just came out with the jobs data, because we were talking about a lot of this last week and this week on the Econ Show, saying that we thought we were going to miss estimates based on some of the data sets we were seeing, and it ended up coming true. And we want to talk about kind of what comes next. Some of this stuff that we normally talk about on the oil side, because the EIA data came out on Thursday, we were able to put a lot of that into that show. So you can go back and watch those to catch up on some of the more specifics on Singapore, what happened in Europe and whatnot. And then next week, I won't be here, so we're gonna just do things a little bit delayed, and we'll try to put out something on Thursday instead of our normal schedule. So with one last thing before we get into it, we also have our summer report coming out, where we're actually going to provide a projection on where we think frac spreads are going to go through the rest of the year and then into Q1 of next year. And then we do a deep dive on our new product with the NGLs, condensate. What does that look like going through the system? Looking at horsepower available, pumps, from the E&P level on down. So reach out if you'd like to learn more. So now without further ado, we come in with a -2. So we actually have, we went from 226 to 224. Now, the reason why we had that drop was just some of the smaller, like Cherokee was one, and San Joaquin was the other that saw some of that decline. Now, everything else was held flat. We're in this pivot point, and this is what we've been talking about, where June, the end of May into the beginning of June, we're going to see kind of this flat line, and then we're going to start to see this acceleration point. Now, the acceleration point is coming up this week, and as we go into next week, it's going to be a steady grind. It's not like we're going to see this big gap up. It's going to be the steady move where we think that you're going to get to about 235 spreads by the end of June. But when you look into July is when when we talked about it in December, we thought we were going to get this shift up, and Q3 was where a lot of plans were already laid out to see this acceleration point, and we're starting to hear that come across from the E&P level in terms of picking up rigs as well as picking up additional spreads. Now, one of the counterpoints to that is the rise in labor costs as well as steel prices. So those are things why some of this delay we projected was going to happen, because now you're at this point of, okay, well, crude prices are $69.50 on the futures curve. How much can I pass through? Because when you look at the oil field services, they're going to try to pass through additional steel prices, additional labor costs, additional diesel prices. So all of these things have to be in a negotiation, and you're not going to rush back to buy new steel, hire new people, unless you can get a longer term contract to make sure that it incentivizes everybody involved. So this is why we projected to see some of this pause, and now we think that you're going to start to see some of this come back. It'll be slow. It's not going to be quick. But 235 makes a lot of sense when you look at where the Williston sits, we can get some movement up there, and then you're going to continue to see Texas pick up several crews over the coming few weeks. And that's when we look at the last 3 months. So this is that sharp move off the bottom, and then you can see that we've really had this kind of steady move up, and now we've gone sideways through May into June, and now we're going to start to see that pivot ahead of what we know is coming with Q3. Now, when you look at just where we were versus 2020, obviously you can see the wide delta. But the problem, and why we talk about steel and labor, when you saw all of these spreads go, get deactivated, you had a certain amount of individuals who were furloughed or put onto other crews, and then as this prolonged nature, kept crews out of the field. those furloughs became permanent. And that's why, as you see some of these movements where you need to buy transmissions, you have to buy, pipe, you have to do all of these different things that are going to be very important and costly, just given where we are in this inflation cycle. So that's something else that we're going to talk about. And and we'll talk about inflation a bit, especially when we start going through some of the economic data. But this delta is where you had spreads that were either warm stacked, which, given how long it was, most of them weren't warm stacked, they were cold stacked. So did you turn it on every twice a week? Did you wrap everything the way it was supposed to be? How did you keep the elements away from some of the sensitive equipment? These are the kind of things that are going to make it costly to bring some of this spare equipment back, which is why it's going to take time, and you need to make sure that you have that longevity on that contract to incentivize operation. Now, when we look at what is happening on a global front, so when we look at Chinese VLCCs coming in, they fell by 2. So again, as we've been talking about with China, with India, with Japan, and just Asia in general, we're seeing some of that slowdown. And you're starting to see a little bit of a pickup in refining within China as you have those refiners coming back from maintenance season. You have India that's been maintaining about 85% throughput through this second wave of COVID, which is a big difference versus what it was, where previously, with the first wave, we saw a big drop close to, anywhere between 50 and 60%. So here we're about 20% over that, which is why we're seeing so much product get pushed into the market and go into storage. And this is those pivot points that we continue to see as India is coming out and now looking to purchase for August, and which is normal, but as they start putting out IOC at the different types of tenders, and we're going to see that continue to move through the system as they try to adjust what they have in storage and what they need in runs. So then when we look at what is happening within the U.S. So the U.S. is actually bringing in, so we now have 30 super tankers coming into the U.S. in the next 3 months, which is up from 5 last week, and it's the highest since May 15th of 2020. And we just want to touch on why that's the case. So we talk about this in the EIA show when we go through utilization rates, specifically PADD 3. But when you look at how the cracker or how the refiner is being run, they've really maxed out the top end. And the top end is gasoline, aromatics. So the only real spare capacity that they have in the cracker is going to be at the lower end. And in order to achieve that, you need a heavier crude, which when you look at what comes out of the U.S. from shale, we don't have that kind of oil or the oil necessary to make that happen. So that's why we've been talking about that. We're going to see this increase in imports specifically into PADD 3. And we're starting to see that based on how the super tankers are flagged. Japan was down 5, and this is where we're starting to see some of those pivots, and that's going to bring more crude into the market. And just given where pricing is right now, we have Nigeria cutting prices again. Brent we had Brent cut prices again. We had Angola lower prices again. So that's going to start to bring additional capacity into the U.S. because it's going to make economic sense as we see more tightness between Brent and LLS, which just means that it's less economic to export crude. So we're going to see our exports drop and we're going to see imports accelerate. And again, this isn't going to happen overnight, but this is going to, over the next 2 to 6 weeks, this is going to be the trend, and that's going to support some of that increased runs into PADD 3. But when you look at what are some of the breakdowns that we're seeing, so the Colonial Pipeline outage, we still have gas stations that don't have gasoline, according to Gas Buddy, and the caveat is, some of this is obviously fluid, some of this is just a percentage, but Georgia's still at 19%, South Carolina 18%, North Carolina 16%, Virginia 10%, Tennessee at 9%. Where we still have gas stations that are still struggling to see that normalization. And obviously the Memorial Day push didn't help. And that's why when you look at the implied demand numbers, you're getting some of that skew still left in there because there's still demand getting pulled from the racks into the actual retail arena, which is again going to create some of that stickiness when you look at implied demand versus where it is. So instead of seeing that full move down, we're going to see something a little bit more smoothed out, as we were saying yesterday in the EIA show. So then when we talk about China in a bit more detail, here's where when we look at what Shandong has been doing, you can see that we've had a small increase. This is the one where they're trying to work through as much as they can prior to a lot of the levies that are coming through. So they're trying to increase throughput in order to bring on whatever they can prior to the levies. But when you look at what the additional cost is going to do, again, as we talk about it in the report that came out today, you're going to get this shift. You're going to get this movement where the China is going to allow an increase in fuel oil exports, and we'll show why in a minute. And they're going to try to put pressure on gasoline and diesel exports because they want to increase the amount within China to bring some of those prices down. And if you look at how that's going to shift the flows, it should increase certain grades of oil, which we're starting to see with Urals, as we're seeing Russian barrels, which have actually increased in price. So we talked about decrease in prices from Brent, Angola, Dalio to be specific, Nigeria and Congo, while we're actually seeing some tightness in the Russian market. Now, when we look at Russia, the Urals have gone from about $1.85, $1.65 discount. From $1.85 discount to $1.65 discount. Now, based on some of the quality sides, we could see that tighten closer to $1.50. But once you get to that point, you're going to start to see more, West African crudes get into a better bidding area. So then that should put some support as Urals tighten. So that's why you're going to get some tightness, but you can't get beyond that because you do have additional flow coming from the Middle East and from West Africa, which is going to adjust some of that. But when you look at the flow shifts as the refiners adjust the way they're going to operate within China, you're going to see some of that kick out, and it's going to put pressure on other refiners in the region, specifically within Singapore, South Korea, and Japan, and then Malaysia to a smaller extent, but a lot of that is a little bit of window dressing for Venezuelan barrels. So then when you look at where we sit on the Shandong side, you can see that we're back up to those highs, still maintaining that level, which is why they're trying to work through some of this before some of that pressure comes through. And then when you, again, that's coming down to, how Russia is going to adjust, because then crude grades are going to become more important as China's limiting the blending capacity of bitumen and light cycle oils. So you're going to see some of those quality shifts, which is going to take time to kind of, suss out as to what is that going to do for differentials over the longer term. And here's the problem that we see with fuel oil. When you look at where fuel oil stocks are, they're remaining very elevated, which is why we expect to see, and the market is expecting to see, an increase in exports from China. And this is just going to put more pressure on the fuel oil market in the heavier distillate side, just because we have a lot of that remains in the system. We've seen Europe importing, they had a big build the other day, and we're starting to see more fuel oil and resid get recracked into that lighter end, and again, trying to kind of marry and match with where things are going, which is why Asian demand for crude still remains depressed, because there's going to be a lot of these movements that are just keeping some of these barrels out of the system. They're still well stocked on storage, which is why a lot of this is going to start showing up in US and European markets. So even as we reopen, there's going to be more or enough product to come through. And as we talked about in the Econ show, a lot of the search categories for reopening activity peaked April 25th and then started to come back down. So it's going to come back to, okay, well, how quickly do we get some of this activity? How much of it is going to be above seasonal norms, or are we just going to pace that seasonal activity? Because right now we're seeing that bump, but really along the seasonal capacity without that rate of change to kind of close that gap. And this is just something that, again, is pointing to more pressure, not just in the U.S., but abroad, when you look at the food prices and how that continues to surge higher. We've written reports, we've done other videos on how this impacts, because people will go to war over food. There's very few things people will fight over, and food is one of them. And that's why when you start to see this acceleration, if you remember 2010 into 2011, that was the start of the Arab Spring. So when you think about the stress that comes through, that is put on not only the populace, but also the government that typically provides subsidies for food, this is going to stress balance sheets that are already stressed from trying to deal with everything that we've been talking about when it comes down to stimulus from the government level on the monetary and fiscal side. So they've already stimulated, and now they're facing these rising prices, which are continuing to go up, because when you look at just general precipitation weather, we're having a big heat wave come through the U.S., and then droughts continue to become a huge problem in Brazil. So right now there's pressure on what's going to happen in the northern plains, which is becoming a bigger issue for the U.S., which could impact yields. Again, it's still early. There's still a lot of movements, but in Latin America, it's not as early. And that's when you start looking at some of the impacts where the U.S. could still be okay, but Latin America is where we continue to see huge shortfalls in terms of potential yield. Again, putting the bid in under this price and increasing the pain on just general consumers, because obviously you need to eat. So this price increase is going to put additional pressure on consumption. And then when we shift to the U.S., we've been talking about it nonstop. We talked about it last year. We've talked about it at the beginning of this year. Price increases continue to move down the supply chain, increasing inflation as we get a continuous move in terms of just what people are spending. And this is just looking at what is going to be that next wave. And what we've been saying is the next wave is going to be labor, and but more importantly, it's going to be rent and ownership. And when we look at primary owner equivalent, when you look at just that bump up, it's really going to be driven by rent or housing, and then you're going to get that labor push, which we actually saw after seeing some continuous wage compression over the last few months. The last month or two, we've actually started to see some of that wage increases, which again is just going to compound, because those wage increases, like I said, get passed through or as much as possible. So that's going to send prices up again, which is just going to put more of that tailwind to some of the CPI numbers. And this is just looking at average rents across major largest metros. You can see just the acceleration that we've seen off the lows, which is yet to really get reflected in any meaningful way because of the fears of not getting paid. Because if there's an option for landlords to put in, unknown, where they don't know if they're going to get their money, but that gets defaulted as a zero. So as we start to see some of this normalize, that's when you're going to start to see that get priced through. Now, one of the things that we've been talking about is, commodities are pricing in this massive inflation, and bonds are pricing in pretty much no inflation. And the argument that we've been making is that they're both wrong, that, there's not as much inflation at that level because there is a certain amount of speculation that's been coming into commodities in general. This isn't just, oil or grains, but just on a general level, we've seen this elevated, which is something that we're talking about when you look at credit impulses, prices, when we talk about PMIs, PPIs, what's happening for the consumer. We're going to start to see some of that pressure coming down, which is going to happen across. But as we've been saying, the pressure is going to be less about this massive correction and more about a sideways move or just this slow grind lower, just because the things are slowing in Asia, as we talked about in Econ Show segment 5. And this is just looking at what has happened with Chinese PMI as well as those credit impulses as we continue to see them take liquidity out of the market. We had another big move lower with liquidity as China continues to try to normalize some of these, the very hot market that they've created. So then when we look at the U.S. and we talk about non-farm payrolls, so as we were saying, we thought we were going to come in something closer to about 300 to 350, just given some of the other data sets that we had seen. It came in at 560 or 559. well below the survey. But when you look at just what PMIs were saying, where hiring actually went down, and it was down to, and we talked about this in the econ show, but it's down to 50.9. So it's still an expansion, but when you look at production dropping because of shortfalls, because guys don't have inventory, their supply chains are banged up. So because of that, you're seeing some of that pressure, which is reducing hiring, and as well as just causing people to be furloughed. But that is where we're starting to see some of those different breakdowns. But then when we look at the unemployment rate, things are getting a little bit better. But when we turn to the earnings side, average hourly earnings was expected at 1.6, came in at 2%. Average hour earnings month over month, instead of being at 0.2, was at 0.5. Now, it looks like, 0.5, but think about the skew that because you're going to have more people coming in because the hiring has accelerated at some of the lower wage level, which is drawing some of that down, but you're still getting an increase, and we're seeing some of this acceleration. All the while, factory orders are coming back down, which again leads to some of that delays that we're seeing, resulting in a reduction in some hiring or a pause, because services continue to be the driver as manufacturing actually was negative. And a lot of that is coming down to some of these issues that are also driving up PMIs in a negative way, which is what we talked about in the econ show. So these are things to watch. Durable goods was down, but when you take out transportation, it's fairly in line. So that's where we're continuing to see the shift from durables into services, and that's something that we talked about in the GDP episode. I think that was segment 3 on the econ show. But when we look at the labor market, the labor market still has a lot of slack in it. We're 10 million jobs short of its pre-pandemic. And then if you take where the trend was pre-pandemic, we're actually even shorter than that. But just holding things a bit even, you can see that we're about 10 million short. And I thought this was a good quote from PIIE, where when you look at, although employment remained well short of normal, numerous other signs were characteristic of a very tight labor market. Job openings are at a record level, and in March, the quit rate was at a historic high. There were 1.0 job seekers for every vacancy, still somewhat less tight than the pre-pandemic labor market, but wages for production and supervisory workers, rose 0.5% in May, an increase that likely understated the true increase in wages because of the addition of lower wage workers in sectors like leisure and hospitality. Holding the industry composition constant, wages grew by 0.6% or 7.2% at an annual rate, making composition-adjusted wage growth in April and May faster than in any pre-pandemic 2-month period since the early 80s. So that's where we're starting to see some of that movement. Again, that's going to cool off a bit. But the reason why it's going to cool off a bit is because a lot of this, some of this emergency money is starting to expire as early as, I think it's June 12th. Yeah, June 12th is the first where we're going to see some of this expiration, and then people are going to be forced back into the market, or you're going to see an acceleration, and a lot of these individuals are going to be at the lower end of that, which is going to draw down some of those numbers again. But even though they're going to be drawn down, those individuals are still going to come back at a higher level. It's just not going to be the same type of bump that I think some of the market was expecting, because the pain was at the bottom, and because of that mismatch of skills and wages, that's why the wages are going to be there. There's going to be an increase, but it's not going to be the same type of increase we wanted. And it'll also be slower because, as we were saying, you're going to get that bounce, strong bounce off the bottom as we had. And then it was going to be that slow grind because there's a lot of disruptions. There's still manufacturing issues. Companies are still trying to protect price and margins. So they'd rather have people work more hours instead of hiring a whole new person, worry about training them up. So again, that's where we're still going to get some of that slack, which is why when we talk about what is happening in the wage side, this kind of gives it in a different way when you can see where things are going on a chart level. Year over year, when we look at the hourly earnings, obviously we're still below that pre-pandemic level, But when you look at that percentage, it's still moving in the right direction, especially when you look at the orange line, how we're still seeing positive growth, which is just, again, something that you want to see on the labor side to try to make up for the inflation that they're going to have at the spending level. And then when we look at the jobs report, and we'll go through some specifics next week in terms of one of those different pieces. On the negative side, you had the U.S. economy obviously missed, but April figures slightly revised up. U3 was down. U6, which I think is a better gauge in terms of people who are underemployed. But you also had people who are forced to do part-time that would want to be full-time, which is still a negative. And then the share of people in the workforce had a small dip, but that's normal because as more people come back, we're getting this disconnect between the share of people in the workforce, but that's the retirements, people that have yet to come back looking for a job, and then the yearly wages overperformed by a massively by negative 0.4% of the expectations, rising 2%, while the monthly figure also beat prints of 0.5. Then when we look at the other positive side is there was a big decline in people who have been unemployed for 27 weeks, makes up 40.9% of all unemployed. So here you can see just people are starting to come back into the workforce and take those jobs. And then when we look at the PMI side, this is where we continue to see that ISM services, which again is kind of driving some of these additional price increases, because deliveries are still taking a long time, and then business prices are now back above where they were in 08 and tracking closer to where they were in 05, which is creating some of that additional push. Now, one of the things that we've talked about in several articles and whatnot is some of the wealth divergence that we've seen. And this, I thought, was a really good slide where net worth has declined since 1989 while wages remain stagnant. And I think the problem that we've seen is wages haven't matched inflation. Then you have a layer of debt that has been increased based on not only consumption, because as we all know, millennials like to spend, but there's also a certain amount of debt from housing, from school. If you are 40 and you want to own a home, how much does it cost versus what it costs in 89? If you want to have a car, if you want to have, school, when you look at some of these key components, we've had this big increase in debt. Now that is weighing on not only the income, so median income has really stayed flat over that period of time. And then the wealth in terms of, assets owned, all of that continues to drift lower as the debt goes up. So again, this is that shift that we continue to see as we get a lot of frustration in terms of where individuals are versus where their parents were or grandparents were at the same period. And again, this is that skew that we're seeing on the commodity side on these bubbles, even though the Fed has come out and said that they see no bubbles in the market. And my running joke is, well, if everything is a bubble, then technically nothing is a bubble. So if you want to just think about that in its own right. And then when we look at some rising fears, so this is a chart that's just looking at some fear on household balance sheets, because balance sheets have started to all of a sudden get worse as people have started to go back and spend. Household sector credit to GDP ratio across advanced economies has turned sharply higher. So again, this is going to put some pressure on, well, what is spending going to look like, which is why we talk about China last in segment 5 when we talked about some of the weakness that we've continued to see in spending and consumption, because as prices continue to drift higher and wages, they've started to catch up, but they're still far back from where they should be even pre-COVID, which is going to create some of this additional strife in general. Now, one of the other slides that is interesting, and we'll talk about it next week when we look at the jobs numbers in a little bit more detail, but one of the interesting things is the long-term unemployment, because there's a lot of bifurcation in these numbers where some things are really good and then some things are really poor, and that's why we're trying to use multiple data sets. So like Dallas Fed showed that jobs actually came down, and then PMI showed that there was a big reduction, and not just one PMI, but multiple PMIs from Fed as well as market showed that there was a slowdown in hiring. So that's some of the headwinds that we're going to face into June, because you had some additional seasonal hiring as people, we're getting close to summer, people are going to go on vacation. So that's going to get some of that shift. Labor shortages, it's going to be interesting to see how this goes, because part-time for economic reasons still remains elevated. So as those part-time individuals become full-time, that's going to take a period of digestion. And again, these are things that are going to be interesting to see, that we'll kind of go through over time. But we hope you have a great weekend, and we'll give you a better sense of timing. We're definitely going to have the Frac Spread show on Friday, and we'll put something out on Thursday that's going to be a little bit of a summary of what we missed and not kind of our normal shows. But then we'll go back to our normal schedule the following week. So have a great weekend. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.